Best Buy reporting fourth quarter sales that were better than feared, prompting the positive stock reaction. Enterprise comparable sales declined 4.8% during the quarter. That's compared to estimates of 5.3% of a decline. The retailer also increasing its quarterly dividend. Overall, the business outlook anticipates industry sales stabilization this year. Here with more, we've got Sean Dunlop, who is the Morningstar equity analyst here. Sean, thanks so much for taking some time here this morning. First and foremost, I want to get your read in on the report and if the worst is behind Best Buy.
Yeah, I would say a pretty decent earnings all in. It was 14.65 billion in sales, which edged FactSet consensus. Adjusted earnings per share were $2.72. That was obviously better than consensus, better than our own estimate. I think more importantly is as we look forward, the firm had the confidence to raise its dividend. That looked safe, and negative 3% to flat comparable store sales for the year to come is positive. With a $169 million restructuring, the firm is looking at flat operating income margin for the year to come, which is quite a bit better than we'd expected, and certainly better than you would expect given the sales environment that the firm still finds itself in. So on balance, looks like we're starting to hit some of those replacement cycles from the COVID pull forward. Could be that we're through the worst of this patch for Best Buy.
So if we're through the worst of the patch, then when do you expect to see a return to growth? Is that something that you see playing out before the end of the year?
Yeah, I think so. So during the first two quarters, I would expect that we would see negative comparable store sales. The firm obviously continues to close stores at sort of a 1% to 2% annual clip. They plan to close another 10 to 15 this year. I think as we move into the back half of the year, Q3 is where we're starting to pencil in real growth year over year for Best Buy. And Q4, if we teased out the impact, they had an extra week in this last year's Q4, but if you tease that out, we would expect growth for the year to come.
Where in the key categories that you're tracking are going to really prove that Best Buy can get back to some of its golden days, if you will? Because appliances, that still got hit hard in this most recent quarter. And we're still looking across where the consumer environment actually leads some of the spending back into the categories that were distressed, at least in this most recent Q4 here.
Yeah, it's a great question. I think we're going to continue to see pressure in categories like appliances and home theater. Those have longer replacement cycles. So if people bought those in 2020 or 2021, they're not going to need to replace them in the near term here. The other factors, obviously, we've seen quite a bit of a slowdown in the housing market, and there's natural replacement that occurs with that. So I think we'll probably see it first with laptops. The good news is we're starting to see that now. Best Buy cited positive unit volume over the most recent quarter within their sales base, and there really wasn't a refresh. There weren't any new features. There wasn't much innovation that would drive an upgrade cycle, which means that could be read into as just being a natural replacement cycle. So I think we'd see it in laptops first. I think as we move forward, we'll start to see it in phones, and then it'll spill over into some of the other categories over time.
Sean, are we seeing an inflection point when it comes to laptops and PCs?
I think so. Yeah, I certainly think we'll see it as we move through the first half of this year and into the second half of calendar 2024. I think that's where we're really going to see it. Obviously, consumer electronics are a little bit unique categorically. So if I'm a consumer and I have a phone and I've owned it for 3 years, I can pretty comfortably defer an upgrade for another year if I need to, if macroeconomic pressure remains stout. And the trouble from an industry perspective is that you don't get that sale back the way that you would in some other categories. So if consumers continue to feel pressured, they can defer some of these replacement cycles. I think we will start to see it. We're seeing an increase in real hourly earnings across the board. Obviously, there's some room to go in terms of recovering savings rates. Home starts are obviously slow. Interest rates remain high. Revolving credit balances remain high. But we are cautiously optimistic about the health of the consumer as we move into the balance of the year.
And then just lastly, while we have you here, Sean, I mean, we think about the year of stabilization, year of sales stabilization that the company is banking on here. What does that look like in terms of what investors should expect for the stock price continued trajectory?
Yeah, I mean, I think given the market's move today, obviously the stock is up 5 to 6%. That brings us into a range that we'd consider fairly valued. So as you think about it from the perspective of investors, you're looking at roughly a 5% dividend yield. You're looking at repurchases, I think $350 million of repurchases in the year to come. That's probably what you're looking at in terms of total shareholder return. You're not going to see tons in the way of capital appreciation for the year to come. That would probably be how I would encourage investors to think about it.
Morningstar's Sean Dunlop. Thanks so much for taking the time here today, Sean. Appreciate it.
Appreciate it.
Thanks.